I'm here with YC-alum, the founder of the Enterprise Rising Conference. Casey, who is Enterprise Rising for?
Enterprise Rising's tagline is 100% enterprise SaaS, 100% Midwest, and 100% startups. So if any of those click with you, listener, and sounds intriguing, or better yet, 2 or 3 of them click with you, then this is going to be for you. And if you're an investor, over 50% of the room are startups that are live with revenue. If you're a founder, all of the speakers are successful founders or active investors. Nobody hand-wavy, nobody wasting your time, and all the talks are hyper actionable.
How is Enterprise Rising different this year?
If you've ever attended an online event, you know networking sucks. Slack and Discord really just don't cut it. So we have custom built for Enterprise Rising 2020 an online platform that's like Startup Masterclass meets The Sims, where every attendee has an avatar, you're in a building, you're sitting in chairs, you're sitting in couches, you're having real video chats with the people next to you. So what we've done is we've recreated an actual virtual environment where networking happens just like it does in real life.
Casey, when is Enterprise Rising and how can people get involved?
Enterprise Rising is the end of October, the 20th and 21st. It's 2 full days. It's all online, so you can dip in and out for as much or as little as you want. Go to enterpriserising.co. That's enterpriserising.co. And you can use discount code UPSIDE to score 20% off as many tickets as you want. So discount code UPSIDE at enterpriserising.co. All the details are there. The entire conference is online. It's going to be a great time.
We looked at the revenue growth of about 500 B2B SaaS businesses over 4 or 5 years. And we looked at like what's the ratio between like starting MRR versus ending MRR, whatever that was, typically after 5 years. And we found there's a very clear power law. There are like, out of the 500, there are like 4 or 5 companies that do incredibly well. Like they are, 3,000 times as large as they were at the start.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Former Fantasy Commissioner himself, Eric Hornum.
You know what the worst excuse in the world is, Jay?
I can't wait to hear what this is.
I'm too busy. And I hate when people use the I'm too busy excuse. This year, I'm using it. I'm pulling it out, and I am just too busy to run a fantasy league.
I feel like the commissioner position is a mostly thankless job.
It's mostly thankless, and people don't really understand how much work goes in, especially around draft time. Once the season gets rolling, depending on how good of a commissioner you want to be, like a great commissioner would send out a weekly update and have jokes and link to stuff, and that would be like a great commissioner. I was never that. I think I got like 2 or 3 weeks in one year, and I was like, this is so much work. But around draft time, especially if your league has like some rotating spots where people are in one year, out the next, whatever, dude, it is so much work because it's not like at the office where you're like, oh yeah, everyone has 9 to 5 free. I can look at your calendars and we can figure out a time for all of us to meet, even if it's inconvenient. Everybody always has an issue with everything. There is no time that someone doesn't have an issue with something you do.
I think there are times when people don't really have an issue, but somebody creates an issue because they feel like there needs to be at least one issue.
Yeah, exactly. There is just always an issue. Oh, we're going to do 9 p.m. on Tuesday night. Does anyone have anything going on? Well, not really, but I like to be in bed by 9:30. All right, come on. Like, do we need... Or like, this year it's nice because so many things are canceled that people have more free time, so I'm sure it'll be easier to schedule. But we always have like, I have softball on Tuesdays and Jimmy has volleyball on Wednesdays, and good luck working around that.
Are you in any other leagues? See, this is the only league that I'm really counting on happening this year, and so I need it.
Yeah, you texted me a week ago and said, get your stuff together, Commissioner. And I said, I need to get my stuff off of my plate to another commissioner. So that's what I did. But yeah, I'm going to be in 2 other leagues most likely. One of them doesn't feel like it's going to start, but one of them already has a draft date set.
But this has to be like the most intricate and interesting, right?
I just feel like it's different. It's an auction draft. There's not a standard amount of people on the bench. There's not a standard amount of starters.
Two quarterbacks.
There's a lot of flex. I think it really means that you have to know football to do well in this league. And we've seen when people don't know football, like me last year when I thought I had time and didn't, or me this year when I can't name a single like starting skill position set besides the Browns, it's going to be an ugly year for me. I'm telling you that.
Well, I thank you for your service as commissioner and everything you did to help this one league go as well as it could, similar to our friends at Ethos who help people live the one life they have to live the best way they can.
And you know what? Usually playing fantasy football makes my life a lot better, so it makes sense. But I do also like that, like our guest today, our league, Jay, the league that we play in, is a little bit different than the competition.
That's right. Today we're having a bit of a part 2 episode, which I'm excited about. We're talking with Einar Vollset, the general partner at TinySeed. TinySeed is a year-long remote accelerator designed for early-stage SaaS founders. We spoke with Rob Walling, the other co-founder and partner of TinySeed, a little over a year ago. Now TinySeed has gone through their first batch of accelerator companies, and it'll be exciting to dig in with Einar to hear a little bit about how that went and what they learned in the process.
One of my fantasy football draft strategies, Jay, for the longest time, and you tried to copy me on this, I think, one year, is to draft undervalued wide receivers like Jarvis Landry. Perfect example. Dude gets drafted 25th overall and produces at 11th overall every single year. And he's got some upside where he could be a top 5 guy if he has a year where he goes off. I feel like that's a lot like TinySeed. They're looking at undervalued companies who have upside potential.
They're also looking at companies that have lower downside potential, similar to your friend Jarvis Landry.
Oh, in fantasy football terms, high ceiling, high floor players.
Love it. Well, when we talked with Rob, we talked about wanting to get a little bit more into the model and the math side of things, Eric. So today, it's finally happening. This is your chance. You can ask all those questions of Einar.
Let's do it.
We'd love to hear what you think about this episode as you listen.
Reach out to us on Twitter at UpsideFM
or email us hello@upside.fm.
And we'll get to this interview right after this. Let's bring in Rob McDonald, a partner at Taft, Stettinius & Hollister, to teach us about private placements and fundraising. Taft is a law firm known for assisting entrepreneurs across the heartland. And as a quick reminder, the following remarks by Taft attorneys are for informational purposes only and are not legal advice. This information is not intended to create, and receipt of it does not constitute an attorney-client relationship. No person or organization should act upon this information without first seeking professional counsel. Rob, you are becoming a regular on the podcast, our third co-host.
It's great to be back. Excited we were able to get through all that legalese.
Oh, I know. You gotta love a good disclaimer.
Oh, yeah.
And speaking of legalese, an important part of every fundraising negotiation is the term sheets. What are the most important terms for an entrepreneur to be aware of when raising capital?
Obviously, valuation and amount raised are two of the most important terms. These two terms combined will define how much of the company will be sold. However, with liquidation preferences, dividends, and other rights tied to securities, the percentage of ownership alone could be misleading. So it is important to fully understand the economic terms and how they play out in the long run. Beyond the economic terms, the founders will also want to pay particularly close attention to what I call the power terms. Who votes on what, who holds what board seats, etc. It is easy to lose sight of the power dynamics if founders are too focused on the economics. Lastly, I encourage founders to look at deal costs. Some investors require all kinds of terms that cost the company money, sometimes for good reason. Things like key man insurance, board travel fees, legal fees for investors, etc. It is worth tracking how much the transaction will cost to complete top to bottom.
Awesome. If people want to learn more about Taft or yourself, where should they go?
They should go to www.taftlaw.com or my Twitter at RWM.
Einar, welcome to the show.
Thank you. Very good to be here.
It's great to kind of loop back on the TinySeed story a year after talking with Rob. And so I'd love to hear from your perspective how you and Rob began talking about TinySeed to remind us of the origin story and also just get your perspective.
So I've known Rob pretty much since he started MicroConf. I guess it's coming up on 10 years ago now. So that was right after. So I did YC in 2009, winter 2009. and sort of was very much in and around that Silicon Valley startup, go bigger or bust, back in, I guess, 2009, 2010, touch on a time frame, and sort of was aware of Rob and what he was doing at the time with his book and with his sort of approach, which I thought was refreshing and new, and sort of got connected into that community. And I think I've been to every microconf other than the very first one, sort of one of the conferences that I always make sure to go to. Yeah, we connected through the years there. And really what happened was I got pulled into doing, after I sold my last business, which was back in 2016, I got pulled into doing sort of the private equity world. So that side of things, which is, I think at least for most people who live in Silicon Valley and probably a lot of other people, it's sort of an unopaque black box type situation. But I got pulled into it initially doing due diligence, and then started to do some buy-side deals. So basically finding companies and introducing companies to private equity firms. And then eventually got started doing more of the sell side. So people would just contact me from the microconf community and from the YC community saying, hey, we have this offer. It just came in cold. What do you think? Is this a good offer? And initially I would just tell them, it sounds good, or no, this is a terrible offer. You should go, get a better one. But then started doing the sell side stuff, and people actually just asked me, said, we're thinking about selling. Would you mind running the process for us? You seem to know what you're doing. So I did that side of things, and really through that understood how sort of middle market private equity had sort of moved down market enough that, if you had a business that was doing more than about $1 million ARR, there were a lot of more and more buyers. So really prices had come up and competition among buyers had come up. And so I guess 2018, I want to say, I'm not sure actually now. We're at MicroConf. Rob had just sort of exited Drip after the acquisition. And I just pitched him. I said, to me, it seems to me like there's a hole in the funding market that's sort of in a similar type hole that, YC in first round filled back in 2005, 2006. And then it turned out that Rob had been thinking very much the same thing. And it was sort of fortuitous timing. I think if I'd hit him with it like a year before, he'd still, he was embroiled in still working on the Drip post acquisition. He's probably pretty burned out. But at the time he was weak. So I swept in and I was like, this is what we should do. And he was very much like, listen, I'd love to do this. I want to support the founders. I really think that there's a hole in the market here. For him, because there are some bootstrapper extremists around who are like, you should never take any kind of money. And often what I found with these people is that they have a wife who's a doctor or makes a ton of money, or they already have a bunch of money, and then it's easy. But the risk for a lot of people, if you're just a consultant getting by, how much risk do you want to take on? You still have mortgage, you still have kids. So he very much came at it from support the founder side, whereas I'm a bit more mercenary. I just thought it was a good investment type scenario. And so he was interested in doing that. But the one thing he said was, I don't want to do any fundraising. He said, if you do all the fundraising, then sure, we'll do it. And I think part of it was that he didn't really believe that, there was enough investor interest. And then once we started once he realized that was real, then it became real pretty quickly, actually. It was sort of I think we talked in May that year, April, May, and then we sort of had opened up applications. I guess it was in January or February, something like that, the year after.
You mentioned this hole in the funding market, and for our listeners who aren't maybe familiar, what exactly is that hole?
So the way that I think about how YC fit in is kind of instructive, because YC is very much when they came on the scene in 2005, 2006, if you wanted to start a tech startup, then it was very much you sort of had to have a business plan. It was a bonus to have an MBA, from Harvard, and you probably had to have some rich friends to, give you $250,000. And then, it cost a lot of money. This was sort of pre-AWS and all that sort of things. It was just expensive to get started. And so what YC did was no, if you just have smart nerds and smart, hackers and give them just a little bit of money, when I did it, I think we got 20,000, 30,000, something like that. And, I went through the same cohort as Airbnb, and they got the same money as everyone else. And they sort of filled that market and said, listen, you don't need fancy business plans and all this spending on infrastructure and buying a server rack before you do all this stuff. You could just go out, build it, launch, and very quickly go to market. And I think obviously they've proven pretty successful. The one thing that sort of the hole in the market, I think, that we're trying to fill is more in part because of the success of YC, it became a dominant investment structure to use like a safe. Typically, like say YC is a little bit more sophisticated than that, but conceptually what they do is they just basically give you an uncapped safe and say, you know, because they're in their model, like what they're doing is sort of unicorn, decacorn hunting. So it doesn't really matter like if they don't capture all the value. But the problem with that is that the way that the venture investment environment has changed is that there's more and more capital coming into the market, but they're chasing fewer and fewer deals. So these things get higher and higher valuations. And, you know, higher valuations, and then there's more cash chasing fewer and fewer deals. And so it ends up being that capital concentrates in a very small number of these types of businesses. Like typically, like a good example is Sam Altman, who I actually know a little bit. He put a piece out in, I guess, January, February, like how to invest in startups. And his shtick was like, you should try not to invest in anything that couldn't be like a $10 billion business. So no longer is unicorn enough. It has to be a decacorn. And what that means from the kind of businesses that we support is like, if you come in and say, hey, you know what I would love to do? I'd like to build a business, you know, a SaaS business selling to builders, and I'd be perfectly happy with a $100 million exit. They're just going to laugh you out of the room on Sand Hill Road. Like because it doesn't make any sense. Nobody's doing that. So what we were trying to do is to say, okay, given specifically the nature of these B2B SaaS businesses, like they're capital efficient, they typically inflect to being cash flow positive at about somewhere between 1 and 3 million ARR. They have gross margins of 90%. They have net margins of, you know, can have net margins of 50% or above in some cases. Can you come up with an investment structure such that there's a balance between founder friendliness in that there's capital coming to them and you're not taking advantage of them, but also investor friendliness to the point where like an investor makes sufficient return that they're going to want to keep reinvesting? Because I think a lot of the time now what happens, and I see this, you know, particularly around where I live, which is near Silicon Valley, like people put together a deck and then they look at it and says, there's no unicorn or decacorn in this deck. So let's just slap a couple of slides towards the end that says, this is how we take over the world. And sometimes that works, but is that great for the investor if they do like an uncapped safe? Probably not, you know. So you need to find that balance between investor and founder friendliness to really like divert capital into this market. And because fundamentally we think that there can be, you know, we're looking to back hundreds of companies a year eventually, and we think there are thousands and thousands of these kind of businesses around the world that could be built.
The Silicon Valley model became that way, or as I understand it, became that way because there's this kind of notion that all of these businesses are going to fail. When you look at, and that means one of them is going to kind of return your fund. You know, 3 are going to fail, 3 are going to break even, 3 are going to 2 to 5x, and 1's going to return the fund.
Correct. The power law.
Yeah. So when you look at TinySeed style, microconf style companies, how's that same distribution work out?
So it's actually quite similar. Like if you look at the distribution of outcomes, even in this space, then you will still find that if you have a big enough sample, there will be some companies that really take off like a rocket ship. And I think it's a mistake to go into venture investing, even at the sort of the industry and the size and where the area we play in, and not understand the power law. Because I think that's the fact of the matter is, like, we have some data in our investment memo that shows that we got access to partly because we do the, you know, state of independent SaaS and all this stuff, where we looked at like the revenue growth of about 500 B2B SaaS businesses over 4 or 5 years. And we looked at like what's the ratio between like starting MRR versus ending MRR, whatever that was, typically up to 5 years. And we found it's a very clear power law. There are like, out of the 500, there are like 4 or 5 companies that do incredibly well. Like they are, you know, 3,000 times as large as they were at the start. Versus, you know, there's a bunch in the middle that do pretty well. And like you can get, you know, good returns from them. But to deny the fact that you're still in a power law environment, I think is setting yourself up for failure.
Is that power law environment, so on the upside, I understand that there's still going to be some that break out. What about on the downside? Are there as many more or less failures in a given sample?
So I think there are many fewer failures. I think as a founder, if you're going to go into a space, like what are my chances of success? You're better off going in and like building a B2B SaaS business, because once you get some kind of attraction, you're probably worth something, which is not true for, say, a home pet grooming service. If you get a B2B SaaS business and it goes north of $1 million ARR, you can sell it for, you know, revenue multiples effectively. And usually those kind of outcomes are, at least if you haven't completely diluted yourself through a bunch of, venture rounds, then, the kind of outcomes you can have, even if you have a, 1-2 million ARR B2B SaaS business, is life-changing for the founder versus, I see some of these venture-backed stuff and like, businesses shut down and implode even though they're doing 10 million in revenue because they're just geared differently. So they're geared and set up in a way where it's like, if you don't get to 100 million, you're worthless. Whereas I think in the space we operate, both for founders and for investors, there is sort of this middle sort of, thick tail of businesses that'll do pretty well. Now, whether that's so what we don't really know is whether the failure rate is significantly low enough that those mid-level hits in and of themselves are like a venture return. And by that, I mean fund level. So, sort of a 3x plus type environment that we don't know. But certainly we think it's important to, when you are investing in the space, to be able to basically make enough bets and do it with a vehicle that means you have a higher chance of capturing some of those outlier growth companies. And again, it boils down to like sort of valuation too, right? So if you have an exit that's 100 million and you invested at $1 million pre, well, that's 100x. So that's just as good, as if you invested at 10 million pre and it's $1 billion company. Like, it doesn't matter. Like, it's entry price, exit price, sort of venture 101.
So Rob told you that he's interested, but you've got to do the fundraising. So you do these stats and you go out and do the fundraising. What was that process like? And were you surprised by how much easier or more difficult that it was?
So we're just right now raising our second fund. And we can be public about the fact that we're fundraising because we're doing, what's called a 506c offering. The first one we didn't, so we had to sort of be quiet about it, and it was just like connecting with people and like discreetly asking around. But that was actually easier than I thought. And I think to a large degree that was because of, Rob's network and sort of the people in and around MicroConf. We tapped some of my sort of private equity contacts and some of the stuff I'd done through some of the M&A side, Discretion Capital. But really what surprised me was how enthusiastic people were about being part of it, because they were like, yes, someone finally needs to do this. Like, it's bullshit that like it's always, Silicon Valley boom or bust. There's got to be something different here. Like, come on. So that was actually reasonably easy. Our first fund was, it was small. It was effectively, a prototype fund. We raised about 4.5 million, but we were able to do that in 3 months, maybe 4 months, and took a bunch of smaller checks, and we're happy with it. This time around, it's been even easier because we're more well known. We have a bit of a track record, and part of the thing we were doing with Fund 1 was to understand, like, do we get enough quality deal flow, and do we have enough pricing power, and are we capturing sort of the full spectrum of possible growth companies? So one of the biggest downside in this, if you're doing this kind of investing, is if you don't have access to the full spectrum of deal flow. Like, you may think you see a lot of deals, but if all you see are the top, say, 80%, you're probably not going to do very well. You need to be able to access the full 100% of the deal flow. And I think we have some early signs that we're able to do that. And so that's helped tremendously in terms of our fundraising for Fund 2.
How do you filter when you have 100% of the deal flow?
I don't mean 100%. Like, I mean, like, I don't mean we see all deals in the world. What I mean is, like, of all the possible B2B SaaS companies that want to raise money, like, the quality is from the full spectrum is what I mean, rather than like we get all the deal flow. But it's like, it can be tricky. Like, and I'm 110% sure that we decline to invest in some very high quality companies that we'll really regret later. In part, like, just to give you an idea, like, we had in total over the 2 applications, we had 1,500 plus applications. The first round, we had about 700 or 800, and then, about 150 that was in our sweet spot of like 3 to say 15,000 MRR. And the second time around, we had slightly fewer applications, but we had about twice the amount of what we would consider to be quality applications. So we had about 300 of those. Like, we were just out of money. The last time we invested the last batch was 13 companies, and then we're, completely out of cash, which is why we started fundraising Fund 2. But I sort of eyeballing it, like, there's probably another 50 companies we would have liked to have funded if we had the infrastructures to support them and the cash to back them, just out of that last sort of application batch. In terms of what we look at, like, there's obviously some pattern matching and things like we see with things that have worked in the past. It being B2B SaaS, there's just some basic metrics that we always look at. Like, very obviously, we look at revenue. Like, are you growing? Are you declining? What's going on there? Like, what's your customer acquisition cost? Your LTV, obviously, churn's important. But some of it is just like, we look at it and it's like, well, your pricing is probably way off, but that's a reasonably easy fix. Some people don't realize, like, it's surprising how many founders are like, okay, like we have an enterprise type sales cycle. So it takes 6 months and 3 demos and, a lot of time and jumping through hoops and maybe custom docs and stuff. And then they charge $50 a month once they land the client. And we're like, no, you should be charging 5,000 probably. So yeah, but it's not easy. We don't have a magical formula. I wish we did. Like, with the data sets that we have, I've spent a bunch of time looking at, like, are there metrics that you can sort of look at and say, yeah, this company is definitely worth investable, like it's going to succeed. And I haven't found one other than like some really obvious ones, like a company that's growing quickly is probably going to keep growing quickly for a while, which doesn't exactly take a PhD in stats to figure out. So
I think, and you would know this better, but I think part of the YC model is, yeah, we get them early and we put money in, but we're helping them fill up their next round, like upon graduation of YC.
True.
Is there an analog for TinySeed? Like after TinySeed, is there a step that you're really trying to set them up to take, or are you trying to get them to a point where they don't need more investment?
The latter, yeah. So we think of the successful companies, there'll be some, there's sort of 10 to 20% range that will decide this is actually a bigger opportunity than we thought. So maybe they actually step on the more traditional venture train and go and raise a Series C or Series A or whatever afterwards. But really the goal is like after the 1 year sort of remote accelerator, that you're in a position where you don't have to raise any more money. Like, and this boils down to like the kind of companies we invest in. We only really invest in SaaS and mostly B2B SaaS. And because they're so capital efficient, we believe once you get to a certain stage, your future is sort of up to you, and like you have much more optionality than you would do with a more traditional sort of YC type company where like it doesn't matter how well you're doing, you're still going to need money. So you're kind of like dependent upon like investment trends in the macroeconomy at that point, which a lot of these companies just aren't.
The LPs that backed the initial TinySeed fund, and maybe even looking at this fund, are they also investing in traditional venture capital, and this is just a new bucket, or is this a different type of investor entirely?
It's a mix. So there's some certainly that are in traditional venture. There are a big portion who are sort of angel investors, and actually, and I hope my LPs don't mind me saying this, sometimes they're like frustrated angel investors because they've written some checks left and right, but it just hasn't worked out. And I think for that group, really what resonates is the fact that part of our analysis shows that probabilistically you're not going to do well until you have a big enough portfolio. Like I fundamentally don't think any angel investors do really well unless they have a sufficiently sized portfolio. And that's hard for people to do because they don't get the deal flow. They don't have the pricing power. And then, if you're looking to put $250,000, $500,000, something like that into tech to get exposure in tech, it's hard to do that and write big enough checks so that, people will actually take your investment and, get it diversified enough so that you're able to capture this effectively, this parallel outlier type distribution that I'm talking about.
What about the founders themselves when you're talking about them and interviewing them for this opportunity? Have you experienced any difference in how B2B SaaS founders think and question taking on investment versus a traditional YC type of startup founder?
Yeah, they're often just a little bit more humble and value optionality in a way that I don't think a lot of YC founders do, like at least the younger kind. And this is, again, like goes down to the kind of companies that the kind of outcome that the investor is looking for and that the founder believes that they will have. So a lot of YC founders, they come gung-ho and they believe, yeah, I'm the next Mark Zuckerberg. Like it's boom or bust. Like I'm going to be famous. Versus, and that's great for YC and for those kind of venture investors. That's what you want. You want like a really aggressive founder who's like, I'm going to go balls to the wall and just go for it. Versus a lot of people that come to us, in some cases, they've had offers from YC and turned it down because with us, it's like, they're like, it might be bigger and I might change my mind, but if I can sell for $50 million in 2-3 years, I'm super happy. And like, you're like the only investment vehicle where that you would celebrate that alongside us. Like I got a call from a YC founder, like a year ago, maybe a little bit more. And they were doing about $1 million ARR. And they gotten an offer, she called me up and she's like, just want to know, like, you're an M&A guy, like, what is this a good offer? And they gotten an offer for $30 million for their business, and I was like, yeah, that's 30 times revenue. That's a great price, But But their investors were upset. Like, I actually looked at, I know someone who's invested in that fund, and like the investor update was like, yeah, we really need to like make sure that the founders that we're investing with are like aligned for the long term, is how they frame it. Which I'm like, that's kind of sad. Like, I'd rather be in a position where I'm like, yeah, you sold for $30 million? Excellent. Everyone's happy, which is sort of what we're trying to do.
So you mentioned earlier that you have 13 companies in a cohort. Where does, let's say, company 14, 15, 16, 17, they get turned down for TinySeed? Where do they go for funding?
It's a good question. I mean, I do think there's a hole in the market there. Like, certainly, I think there are angel investors who will invest for sure. Like, and we see that, and we have people come in and they're interested alongside. But I like specifically, like if you're in that space, I don't know that there's a lot of really great opportunities that do exactly what we do in terms of preserving that optionality. I think, to be fair, there's an awful lot of capital sloshing around right now. You know, there seems to be an accelerator or three in every single city, and there's some money there. And I think in some cases that's where they get capital from. And I think in some cases they just keep bootstrapping. They're like, okay, well, we didn't get it, but I'm still going to keep growing this thing. To be honest, like probably most of the capital that goes to support these kind of companies are, you know, personal capital, whereas that's your wife working or something like that.
TinySeed is so focused on B2B SaaS. Do you think that this model can work in other verticals like e-commerce or media or something else that's hyper-focused?
I don't know. So in order for it to work, you need, there's a couple of things you need. You need to have a very potentially very capital efficient business. You need to have great margins, and you need to have a market for sort of mid-level successes. And if all those things and the potential for like really outlier type winners, really, to get like, there's a difference between being a well-performing fund and being like a really great fund, and that's basically having the existence of outliers in one of them. And I think if you are in an environment where you can find all those things, then certainly I think that makes sense. I can't really speak to specifics as it relates to, you know, e-commerce or some of the other things because I don't know them that well.
When we're looking at the size of this opportunity, you mentioned $4 million for fund 1, you're raising fund 2. Can this be like a $1 billion fund by fund 3, 4, 5?
Yeah, I think so. I mean, so we're raising for fund 2, we're targeting 35 to 50. So, you know, 10x on fund 2. I think the goal is to expand horizontally, I guess. So, you know, running cohorts based in European time zone, running sort of APAC time zone. So we envisage that this will be sort of a franchise that invests in hundreds of companies a year across the world. Just because, like, it's the nature of the beast in B2B SaaS. Like, there can only really be one Facebook, but like dental software in the UK is going to be different than dental software in Canada. And it's just, you know, there's just a big market in either of those environments. But is this exactly the same kind of software that works in Canada that's going to work as well in the UK? Probably not, partly because of regulatory things and foibles and whatnot. So I think the opportunity is of that size eventually.
Do you guys ever go scouting for a company within a thesis that you have actively?
No. People come to us, basically.
And I guess my last question then is, if somebody's interested in getting involved in TinySeed, like, what is the mark of a good investor into an opportunity like this? What do they need to have be true, or what kind of mindset do they need to have?
Well, patience is one of them. Sometimes we get investors who are like, yeah, there's a dividend portion to your thing. Like, am I going to start seeing cash flows in 18 months? I have to dissuade them of this. I'm like, no, we're an early stage investor and you probably won't see any kind of capital back for like 3 to 5 years. I think the ideal investor is somebody who, you know, maybe have thought about, or at least have sort of dabbled a little bit in sort of tech investing, maybe realizing that like they haven't had the greatest return, but they still want that exposure to sort of early stage B2B SaaS. Like fundamentally what we're trying to do on the investor side is to provide like a broad almost index into the earliest stage of B2B SaaS. And if that is something that resonates, then, you know, they should get in touch because we're fundraising currently.
And how do they do that? How do they get in touch?
Go to tinyseed.com/invest, and that's, you fill out that form and I get back to you pretty quickly.
Awesome. Is there anything we didn't ask that we should have asked that you wish we would have asked?
How's Fund 1 going?
That's a great question. So you're going into the second cohort. How is Fund 1 going?
Fund 1 is going really well. The way that I think about Fund 1 is that it answered a bunch of questions around some of the uncertainties you have going in, being, The main one being, can you access the full spectrum of the performance of these kinds of companies? Because it's one thing to say, okay, here's 500 companies, and I do some analysis, and I say, if I index into all these companies, you'll do great. But then the question is, as a fund, are you able to access that full spectrum? And I think we have early indications that yes, we can do that. We've had at least one company that sort of is taking off like a rocket ship.
Holy opportunity, Jay. We just spoke with Einar, and man, this whole space, I just love it.
You love a good SaaS company.
I love a good SaaS company. I love a good just SaaS opportunity. I love the fact that they got 1,500 applications and have taken 26 companies. That's from an investment returns perspective. There's a massive opportunity here for a lot more players in the space.
Do you think that'll happen? Why don't we see more of it?
Probably has to do with LP commitments, I would guess. I think that it takes forever for people to embrace new, especially in the financing space. So when you're used to the venture capital model and it's taken you 30 years to get used to the venture capital model, and there's a Sequoia that everybody can point to say, look, you can be great in venture capital like Sequoia. It's a lot easier for an LP to just there's heuristics there. Or when KKR, it was hard for them to raise money, I'm sure, at the beginning, or Blackstone or anybody in the early 80s, except for via debt. So I think it's just hard to get people to commit money to new ways of investing. And you need to find the right audience.
Do you think it becomes harder in a day and age like we're in right now, where things just feel really confusing, even though the market still seems good right now?
I think it's non-correlated.
Non-correlated? Not related?
Yeah.
Yeah, I mean, I love what they're doing. I'm not the math guy, but even, when we talked to Rob, it just seemed it seems like there's a lot of space here for somebody to do something to our intro conversation. High ceiling, high floor. It feels like a lot of these companies have a high floor, and maybe the ceiling isn't as high on average, but it seems like there's a model there to make work where that doesn't matter. Just draft a bunch of Jarvis Landrys.
Back to the beginning, back to Jarvis Landry, fantasy football, nice little tie in there. I think our friend Tyler Tringus from Earnest Capital has this idea that he stole from someone else. I forget. He gives it a site, so I'm not outing him here. But it's the deployment phase of SaaS. And I think that there are a lot of businesses, and I see this in my full-time job as well, that will be just great businesses that do $1 to $5 million of profit a year. And those businesses are going to sell in the future for a good amount of money. It's going to make those founders rich. And right now there's no great way to fund those businesses. I was actually kind of surprised in our conversation with Einar that they still look for that kind of rocket ship potential in businesses. I thought it would be less of that model coming into this interview. So that was definitely something that I was like, oh, you still need these massive winners to make the investment return, even though you have less losers. And I thought that was interesting.
The nuance there is it didn't sound like they were only investing in companies where they could see where that was going to be true. They just kind of expect that following their own model of investment, it will be true for some very small number of them. But that's not like a filter the way that VC is kind of a filter.
Yeah, 100%. They're not saying, oh, this isn't $1 billion market, get out. But it still needs to have these kind of larger, I don't know. I just thought it was interesting to think about, because when I thought about the model, and I think we talked about this with Rob, there's this idea in VC that you're going to hit a few singles and doubles, and then you're going to, look at us, we got fantasy football, I got a baseball metaphor coming in here, and then you're going to hit one home run that's going to make the fund or not. And it sounds like that math is still kind of the case in this space where you still need to hit a home run or so. Maybe it's a triple, maybe it's not a pure home run, but there's less outs, I guess.
More doubles.
More doubles. I love doubles. One of my favorite seasons of Jose Ramirez, he just was knocking in doubles left and right. So it's an Indians player for the audience who may not be attuned to the MLB.
Well, let's touch down this episode here. Yeah, killing it.
Yeah, that was a slam dunk.
Very meta episode here, by the way, recording a part 2 interview on TinySeed, a firm that invested in Squadcast, using Squadcast to record this bit of audio. We'd love to hear what you think about TinySeed and their model. You can tweet at us at UpsideFM or email us hello@upside.fm to hear more. Thanks for listening, and we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind. So that can't be matched. I'm lighting it on fire. Used to run victory